This is the brief on the conflict between fiscal and monetary policy using the ISLM model. Okay, so let's set the scene. Imagine an economy. It's running at full speed, right? And the government, well, they're trying to win some votes with a big spending spree. But at the same time, you've got the central bank trying to slam on the brakes to stop inflation. So, what happens when these two really powerful forces collide? Well, let's break it down into three key takeaways. First up, you have the policy clash. You've got the government hitting the gas, cutting taxes, boosting welfare spending. And this makes demand just skyrocket, pushing the IS curve, that's the one for the goods market, way out to the right. But the central bank, they fight back immediately. They're terrified of prices going up, so they start selling bonds to suck cash out of the system. And that shrinks the money supply, shifting the LM curve back and tightening everything up. Second, we get this painful new normal. So the economy, it actually ends up right back where it started in terms of output. But, and this is a big but, the cost of doing business has completely changed. Because now money's scarce, right? So interest rates spike. And that makes it way too expensive for businesses to borrow and expand. Basically, the government spending has crowded out or, kicked private investment right out of the market. And finally, there's the fiscal hangover. We haven't actually produced anything more, but the government's finances, they're a wreck. The deficit just explodes and the national debt piles up. And what's worse is that because those interest rates are now permanently higher, the government is stuck paying this huge interest bill on debt that didn't even grow the economy. So, to put it simply, we end up with higher prices, painful interest rates, stalled business growth, and a whole lot of debt. And all of that for the exact same level of economic output we had before. That's the high price you pay when policies just don't play nice together.
So China's central bank is pretty much offering free money to get the economy going again. But here's the thing. Businesses and consumers, they aren't taking it. And that's causing this dangerous economic stall that could really impact the whole world. First, the basic mechanism is broken. Typically, when an economy slows down, the central bank cuts interest rates to get people borrowing and spending. But that playbook just isn't working here. Money is just getting stuck in the banks because, well, nobody wants to spend it. It's kind of like pressing the gas pedal while the car is in neutral. You get a lot of noise, but you're not actually going anywhere. Second, the root cause is what's called a balance sheet recession. See, after the real estate bubble burst, household savings and asset values just evaporated. So instead of trying to maximize profits or buy new things, people have switched to survival mode. They are aggressively paying down debt and hoarding cash just to fix their own personal balance sheets. And finally, this is creating a deflationary spiral with global consequences. Prices at home are dropping, so Chinese consumers are just waiting, thinking, why buy today if it'll be cheaper tomorrow? And to deal with that low demand, China is exporting the problem by flooding global markets with cheap goods, which threatens to crush industries in the US and in Europe. This is a chronic condition that risks trapping China in decades of stagnation, and it looks a lot like Japan's historic economic struggles. So the real question now is, if cheap money won't get the gears turning, what will? This is the brief on the economic effects of tax cuts at full employment. So we're going to look at a pretty specific situation using the classic ISLM model. What actually happens when the government cuts taxes, but the economy is already running at full steam? First, think about the immediate effect. You cut taxes, people suddenly have more cash, so they spend it. This sends demand through the roof, way past what the economy can actually handle. You see this as a rightward shift in the IS curve. But here's the thing, the economy's already maxed out. It can't just make more stuff. So what gives? Prices. They have to go up. And that's how you get inflation started. Second, the market pushes back. As all those prices are climbing, the real value of our money supply, well, it shrinks. This causes the LM curve, that's the one for the money market, to shift back to the left. The economy does end up settling back down to its original output level, but, and this is a big but, interest rates are now way higher than they were before. And finally, this leads to something called full crowding out. You see, with those super high interest rates, it's just too expensive for companies to borrow and invest. So business investment, it plummets. Basically, all that extra consumer spending gets paid for by sacrificing business investment. So, to wrap it all up, a tax cut when the economy's at full employment doesn't actually grow the pie. It just swaps future investment for spending right now and drives up prices and interest rates in the process. And that really shows you the limits of that kind of fiscal policy.
So imagine the whole economy as this massive stalled engine that's stuck in a downward spiral. Shops are closing up, and jobs are vanishing left and right. Well, fiscal expansion is basically the government's absolute nuclear option to just jumpstart that engine back to life. First, we're going to look at the two big levers they actually pull to make this happen. They cut taxes, which immediately puts more cash straight into your pocket to boost demand, and they spend huge on big infrastructure projects, like building bridges and roads, just to get companies hiring and put workers back on a payroll. Second, let's talk about the economic magic of the multiplier effect. It's this wild compounding return where just one single government dollar can literally transform into $3 of economic growth, all because that initial cash just keeps getting spent and respent through everyone's paychecks. Finally, we have to look at the risks, right? Because there's really no such thing as a free lunch. All this money is borrowed, so if they push the pedal too hard or too fast, inflation can totally explode, and the money we're all working so hard to earn completely loses its value. In the end, fiscal expansion is just a super dangerous balancing act, trying to fix unemployment today without bankrupting our future.
First, the central bank buys up government bonds on the open market. Think of this as a direct injection that quickly grows the overall money supply. With all that extra cash floating around, interest rates naturally drop, right? Well, that drop immediately boosts the demand for private business investments. Second, we get this really cool ripple effect across the broader economy. That jump in investments pushes overall demand way up, leading to a higher GDP and a nice bump in everyday private consumption. Now, there's a slight side effect you should know about. Because there's higher economic output, people demand more cash, which actually causes a partial offset, just a little bounce back in those interest rates. But importantly, government spending literally hasn't changed at all during this whole process. Finally, we see exactly why this is such a game changer. This kind of monetary expansion is incredibly effective because it successfully grows both total economic output and private investments. It's a sharp contrast to fiscal expansion like direct government spending, which the source notes isn't as great because it ends up just crowding out private investments. Ultimately, when an economy is stuck in unemployment, pumping money into the system is a powerful way to lower rates, fuel private investment, and drive overall growth without stepping on the private sector's toes.
So if you've ever wondered why massive government stimulus packages sometimes just kind of fall flat, well, the secret's hiding in a huge economic tug-of-war between the goods we buy and the money we hold. First up, let's build the basic framework. Because the ISLM model is really just about finding that single sweet spot where the real economy of goods, that's the IS, and the financial side of money, the LM, perfectly balance out total output and interest rates. Think of it like a giant economic seesaw. If interest rates are way too high or output's too low, these two markets are going to fight each other until they finally level out. Second, let's look at fiscal expansion and a nasty little side effect called crowding out. When the government suddenly pumps a ton of spending into the economy, sure, demand absolutely spikes. But, cash quickly gets scarce, driving interest rates right through the roof. Picture the government as this clumsy giant accidentally sucking up all the oxygen in the room, making borrowing so insanely expensive that regular businesses just cancel their own projects, totally diluting the whole stimulus. Finally, we pivot to monetary expansion, which is the central bank's alternative playbook. By simply flooding the market with cash, the bank naturally pushes interest rates down, making borrowing cheaper and actively encouraging businesses to invest without crowding anybody out. But hey, what if business investment just doesn't respond to those lower interest rates at all? Ultimately, fiscal and monetary policies are completely inseparable, and the true success of any economic stimulus depends entirely on exactly how output and interest rates react to each other.